about my version of triangles. Okay. And I've been trading since 1972, back in the old days when we had the hand chart. And even when we hand charted, triangles are an important element to our trading because chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between the buyers and sellers of financial instruments in liquid markets. Boy, is that a lot to say. Okay. Triangles, or chart patterns, have been around for a very long time and are well known to traders. And what they do is they show us what the relationship is to price on our charts. That make it a little bit easier. Now, patterns, or chart patterns, especially triangles, don't form a trading system, but are rather provide an indication of future trends of a share or an asset. Now, chart patterns, especially triangles, can be incorporated into your trading strategy and your trading system. In fact, I'm what I call a price action trader. I trade using support and resistance, trend lines, and chart patterns. That is it. I look at candlesticks in relationship to one another. I don't look for candlestick patterns. I look for what the candlesticks are trying to tell me in relationship to support and resistance and chart patterns. Now, I'm sure you have heard a lot about chart patterns in online CFD trading and their relationship to technical analysis. You probably know about double tops and triple tops and head and shoulders and rectangles. Now, in order to have a complete understanding of chart patterns, we should also gain a good understanding of the most common on-chart pattern formations. So let's take a look. I've prepared a little presentation, a little chart for you. So let me pop up these charts. And I'm just waiting for it to pop up. There we go. Now, what you can see on here is I've picked out all the main patterns. So going from the left to the right, we can see double bottoms, bull flags, bull pennants, ascending wedges, descending wedges, triple tops, bear flags, bear pennants, inverted head and shoulders, expanding wedges, cups and handles, and head and shoulders. Now, head and shoulders are well known. They're talked about often, but they work much better for the stock market. Inverted cups and handles and right side up cups and handles are an interesting pattern. But if we were to take everything else on this chart, bull flag, bull pennant, ascending wedge, descending wedge, bear pennant, expanding wedge. Guess what? In my definition of triangle, these are all triangles. We may want to separate wedges and rectangles into all different explanations, but I throw it all in the trash. What a triangle is, just like they taught us in school. A triangle is a three-sided object that have two angles converging on each other. Now, the biggest difference between a bull pennant and an ascending wedge and a symmetrical triangle is the angle or the degree of the angle that they're converging on each other. For instance, a symmetrical triangle, both lines are converging in each other at the same degree. A ascending or descending triangle have a horizontal line and have another line coming at it at a different degree. A wedge has two angles at different degrees coming towards each other. Okay. So let's simplify all this and call them all triangles. Because in our world of trading, we need simplified explanations. And there are some people, not people, but there are, oh, hold on, I'm trying to get my marks off there are some gurus, if you want to call them gurus, some market experts. There are some people who teach you and give you rules. And I really don't like rule-based trading systems. They make you do things blindly without following along, just like candlesticks. Candlesticks, when you see a bullish engulfing, you're supposed to do that. When you see 3 black crows, you're supposed to do this. Well, that means you're trading blindly without understanding the markets. You're not looking at what's happening. Basically, in my world, hold on a second, my screens aren't catching up here. Hold on a second. Okay, there we go. In my world, a triangle is simply a triangle. I don't want to give it rules. Okay. I want to say when we see a triangular pattern developing on our chart, that we can expect to see something happening. But until price breaks out of that triangle formation, we're not sure what is going to be happening. We don't know exactly what to do. And trying to say that an ascending triangle is a bullish continuation pattern and we should be prepared to trade, to take a long trade, it's just a waste of your time, waste of my time, and it gets you stuck in the wrong place. It gets you ready to take this long trade that may never, ever exist. And then what happens is it prejudices you. You start thinking about, okay, where is this trade that I'm supposed to have? So in this class, we're going to discuss the basic triangle formations and some ways to properly identify and trade these patterns. The triangle pattern is a specific figure formed on the price chart, typically identified when the tops and the bottoms of price action are moving towards each other like the sides of a triangle. Okay. Let's keep it really basic. When the upper and the lower level of these triangles interact, traders expect an eventual breakout from the triangle. So in other words, you have your support line and your resistance line converging at each other. I don't care whether they're converting at 33 degrees each or 62 and 52. What we're getting is price stuck in this convergence. And at some point, price has to break out. Now, if we can see price being pushed into the apex of that triangle, and we know that sooner or later it's going to break out, we don't need to prejudice ourselves or prejudge. What we do know is at some point we're going to get a breakout. When we get that breakout, whether it's a break up or break down, we can make critical decisions. So as such, many breakout traders use triangle formations for identifying breakout entry points. Now, there are different kinds of triangles that can be seen on a price chart. Before you get into triangle trading, you should understand the difference of the formations. Now, we've been talking about this all along, so we don't need to spend a great deal of time on it. But what you see in the background is this is called a symmetrical triangle. As you see, both lines are converging on the tops and the bottoms of price in the same angle. Now, whether it's a symmetrical, ascending, a descending, a wedge, whatever, don't put names on it. Just say it's a triangle. Okay. One of the most essential rules of triangle trading, or triangles in general, is that when price breaks out, the breakout momentum should carry you the width of the base of the triangle. Now, again, we don't know whether it's going to break up or down, but we can estimate the distance that move should go when it does break out. That helps us to determine our target point because we always have to use risk management. Okay. So we need a target in order to figure out where to, and to figure out our risk reward ratio when we've set our stop loss. So the target is the width of the base of the triangle, regardless of what type of pattern it actually is. Now, the other ones I mentioned are ascending and descending triangles. They're the exact opposites of each other, but the rules still apply. We're looking for the width of the base of the triangle to get the target. Now, they say an ascending triangle should be a continuation pattern upward. A descending triangle should be a continuing pattern on a downward. But there's no rule. You can't tell price what it's supposed to do. You can't tell the psychology of the market what they're supposed to do. All you can do is read it in your charts and make the proper decisions. So even with a wedge, we would use the base of the triangle. Now, it's very important to mention that the ascending and descending triangles sometimes break through the incline level, causing false signals, trapping some traders along the way. The same holds true for horizontal price zones. You're always going to have false breakouts. So understanding what to do and how to evaluate the breakout when the breakout happens, when the price finally breaks out of that triangle, there's a lot more steps that you have to do to determine if it's a false breakout, a reliable breakout, whether you can make a trade or not make a trade. Now, pennants on charts have a similar shape of an ascending triangle, a symmetrical triangle. Some of them we call pennants. But again, you'll hear about it because people like the name planets. You'll hear about pennants, and flags a lot. But I just call them triangles. And the same rules apply. So we have symmetrical triangles, rising wedges, bearish pennants. We have increasing, expanding triangles. We have all different things, but they look like a triangle. They quack like a triangle. They're a triangle. So how can we trade these triangle patterns? Well, the first thing we want to look at is as price is pushed into the apex of a triangle. There's nothing you can do. There's nothing you can determine until you get a breakout, till price breaks outside of that triangle. That's when you got to start thinking, whether it breaks upward or downward. But that breakout candle and his next confirmation candle will give you the buy entry, the stop loss. You already know how to calculate your target. So you've got the three pieces of information you need to do your calculations. And the other two things that are important to look at are our next levels of support and resistance, as well as volume. Volume must support the breakout. If you don't get an increase in volume at the breakout, it's most likely going to be a false breakout, or it's not going to have the momentum, and it's going to carry eventually back into that triangle. The other thing is we have to look at strategic major support and resistance levels above and below the price. If the estimated target price is higher than the next major resistance zone, we need to reduce our target to right below that resistance line. Because most likely, even though the target's saying it'll go up that far, that resistance line is going to stop it. And then we have to reevaluate our risk-reward ratio. So once a triangle is identified on a chart, traders will wait for the breakout, either above the resistance trend line or below the support. After a breakout is confirmed with either a closed candle above resistance or below support, a stop is placed about 10 pips below the last swing low of the triangle. A limit equal to the height of the triangle is then placed. Well, that's just fancy words telling you everything I just told you. So let's go back over and take a look at the charts. Let's see what they look like in real life on charts instead of in sketches. Okay, here is a well-developed, beautiful triangle. At this point, let me just get my marker back on here. We had a breakout. Okay. Until this point now, what the rules would have told you is we would most likely have a continuation pattern. It should have gotten a breakout going this way, but we didn't. But if you notice, this candle here didn't break out. So your breakout candle was this candle. Your confirmation was this candle. Okay. Your trade, it would be accented on that candle. And you would have gotten a nice, because you would have set your stop loss here. You would have set your buy point here. So you would have triggered your buy here. It never went back up to your stop loss, and your target would have been at least to here, and you could have let it ride all the way down. Let's see if I can get a better. Okay, again here. Here we have two prime examples of triangles. Okay, here we have a horizontal and a ascending line. We have a beautiful formation of a triangle. Here is where you got your breakout. Here's where you got your confirmation candle. Your breakout candle is the candle that broke out of the triangle. Your buy point would be the close of that confirmation candle. Not your buy, you wouldn't have been triggered because the next candle is the confirmation candle. You need a next candle to stay outside of that triangle. The third candle is where you would set your, where you would trigger your buy or execute your buy at a price at or near the breakout, the close of the breakout candle. At this point, price never really went back in there below, so your stop loss wouldn't have been placed. Your stop loss would have been placed at the swing low before the breakout. So your swing low before the breakout was here. So that's where your stop loss would have been. Your take profit would have been here. And again, you would have had a nice trade. But again, the reason you wait for that third candle is you want to get rid of those false breakouts. So here we see price soaring up. We get the formation of a triangle, but we don't know whether we're going to get a breakout or a breakdown. So we're prepared for it, but we don't know. Here again, we have a nice triangle formation. Here's the width of the breakout. Here is the candle, the candlestick, and then here is our confirmation candle, and then we would have taken a buy, and we could have ridden this all the way out to here. But it's a matter of practice. It's a matter of seeing these candles and seeing the triangle patterns. And then setting your stop loss and setting your buy point are quite easy. Okay. Now you have to customize them based on your asset, the time frames you're trading, your market volatility. But see, your buy would have been here after the breakout candle, right here. Your confirmation candle would have been here. Your stop loss would have been right below the swing low before the breakout. Again here. Here we set our limit order. Which is the width of the base of the candle, of the pattern. We get our breakout candle. We have our stop loss here. We have our confirmation candle, and we would have bought at this level. Now, a lot of traders don't wait for the confirmation candle, and they set their stop loss a lot closer. I look for only high probability trades. So therefore, I always wait for my third candle, my breakout candle, my confirmation candle, third candle to execute the trade. Because if I miss a trade, I miss a trade. That's life. I'd rather take my time. Okay. So here, breakout candle. This is where we would enter the trade at the close of a breakout candle. This is just reversed in a down, breaking down. Okay, we would have set our stop loss in reverse case scenario at the swing high prior to the breakout. So this is the price we would enter. Here we have our confirmation candle, and we would have executed our trade on this third candle, and we could have gotten a nice little ride down. Now, how reliable are triangles? I find them, when you combine them with support and resistance price action and your candles, very, very reliable. Like I said, this is all that I use for trading. I don't use indicators and oscillators. This is it. Now, I use very tight strategies. I use very tight filters. I look for very close, very high risk-reward ratios. Now, what we always want to do is move the odds in our favor. Okay. So when the pattern ends, the volatility dips to a minimum and the support and resistance lines will be very close. As price moves into that apex, we should see a dip in the volume and the support and resistance lines are narrowing. The market will then usually start to show some preferred direction, the breakout. There's no guarantee of this. As it's best to be prepared for false breakouts and retests of those support and resistance lines. And this is why we wait for that confirmation candle and the third candle. So the easiest way to trade this pattern is to treat it as a continuation breakout and wait for a clear break above resistance or below support. And do this, we'll use we'll put our charts on it and wait for the breakout. While there are instances when symmetrical triangles mark important trend reversals, they more often mark a continuation of the current trend, regardless of the nature of the pattern. Continuation reversal, the direction of the next major move, can only be determined after a valid breakout. So how do we continue increasing the odds in our favor? It's trends, okay, and trend lines. In order to qualify as a continuation of an established trend, should exist. The symmetrical triangle marks a consolidation period before a continuation after breakout. That's a little bit of hogwash. But if we have price moving in a trend, a well-defined trend, the more well-defined the trend and the more well-defined the triangle, the more the trade becomes reliable. Because you can have all types of horrible, horrible things of erratic markets that just happen to make a triangle. But if you had a nice developed trend instead of a whole bunch of just mismatched price movement, if price is moving push and ease, push and ease, push and ease, and price develops into, you see a triangle, or you could have a whole bunch of mess and it happens to form you a triangle. Well, this gives you a very high qualified trade. This gives you a mess. Now, volume is your ultimate ticker. As the triangle extends and the trading range contracts, volume should start to diminish. This is referred to as the quiet before the storm, or the tightening consolidation before the breakout. So once we get the breakout, we should see a jump in volume. If you do not see a jump in volume, be assured it's a false breakout. And then the duration of a trend, if of a pattern. If a pattern forms very quickly and only has a few little bars inside of it, it's not so reliable. If you have a pattern that you're drawing on a very long-term chart or over a very long period, most likely it's not reliable. You need a pattern that's developed over the short term, but not over, or the medium term, but not over the last hour or two. You can go down to 5-minute charts and find patterns. But most times that you find a pattern on a 1-hour chart, it's a lot more reliable. And then breakout direction. The future direction of the breakout can only be determined after the break has occurred. And I'm going to say this again. The future direction of the breakout can only be determined after the breakout has occurred. Sounds obvious enough, but attempting to guess the direction of breakout can be dangerous. Even though a continuation pattern is supposed to break out in the direction of the long-term trend, this is not always the case. A break, and then you need the breakout confirmation. A break should be on the closing basis for it to be considered valid. The breakout should occur with the expansion in volume, especially on upside breakouts. After a breakout, the apex can turn into future support or resistance. The price sometimes returns to the apex or a support or resistance level around the breakout before resuming in the direction of the breakout. So you saw in a couple of my live examples that price didn't just soar back up. By the time we got in, it moved a little bit sideways, dipped it, but it didn't go back inside that resistance area. It didn't come down and close out because of your stop loss. Now remember, price targets, the widest distance of the triangle can be measured and applied for the breakout point. So to sum it up, triangle patterns are easy to spot and provide potential risk-reward opportunities. Traders can quickly know that a big move may be near, as well as a gain objective and the amount to put at risk. Now that you have the knowledge of these powerful price patterns, you are steps closer to becoming a more wiseful and successful trader. And remember, breakout candle, confirmation candle, third candle to execute a trade. This will stop you from making many mistakes. It'll stop you from getting sucked in on false breakouts, and it will turn you into a high probability successful trader. So thank you very much for joining us tonight. Have a great trading week. And if you have any questions, go to OBR Invest and go to their education section, and they'll have videos on all the triangles and all the patterns and some articles and some information, and will help you learn along the way. But remember, practice makes perfect. Practice, 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 and always practice risk management. Always be aware of how much you have at risk and never, ever trade without a stop loss. So thank you very much for joining us tonight, and have a great trading week. Bye now.